think broadcast इसमें
What happened?
broadcast का वो सर वो उसको end कर दें, इसको cross कर दें ऊपर.
Are people listening to us? Okay. So changes in liability alter the revaluation surplus or deficit previously recognized on that asset, so that a decrease in the liability shall be recognized in other comprehensive income and increase the revaluation surplus with an equity, except that it shall be recognized in profit or loss to the extent that it reverses a revaluation deficit on the asset that was previously recognized in profit or loss. So this is one thing. Second is, an increase in liability shall be recognized in profit or loss, except that it shall be recognized in other comprehensive income and reduce the revaluation surplus within equity to the extent of any credit balance existing in the revaluation surplus in respect of that asset. In the event that a decrease in the liability exceeds the carrying amount that would have been recognized had the asset been carried under the cost model, the excess shall be recognized immediately in the profit and loss. So these are the two basic principles. See, if there is a decrease in decommissioning or restoration liability, last slide. If there is a decrease in the decommissioning,
yes. Some people are saying that they cannot hear and see. Can you open that maybe?
Okay, some of our colleague members are saying that they cannot hear us. We are not reaching them. So what should I do?
Can you guys see and hear us? Because on both of my systems, I can see you and even the slides are running. Yes, people are saying yes. Some people are having issues due to their own connectivity. Okay, people can hear and listen. I logged out and logged in. Yes, it is perfect. Salman Yusuf Latif, Talha said yes. It is fine.
So we can continue. Okay, fine. See, we are discussing basically when you are using revaluation model for your asset, and there is a decommissioning or restoration liability related to that asset. If there is a decrease in that liability, the second effect will go to the revaluation surplus if there is any. The second effect will go to the revaluation surplus, except that it shall be recognized in profit or loss to the extent that it reverses a revaluation deficit on the asset that was previously recognized in profit or loss. This is one thing. Second is, if there is increase in the liability, this will be recognized in profit and loss, except that it shall be recognized in other comprehensive income and reduce the revaluation surplus within equity to the extent of any credit balance existing in the revaluation surplus in respect of that asset. In the event that a decrease in the liability exceeds the carrying amount that would have been recognized had the asset been carried under the cost model, the excess shall be recognized immediately in profit or loss. Let's have a look at illustration number 2. There are many points within this concept. I shall try to explain most of them with the help of a couple of illustrations. So let's go to the illustrations. Okay. Illustration, we have illustration here 2. Illustration 2. So this is the illustration. See, the illustration is yes. An entity has a nuclear power plant. If you will work alongside me, so it will be helpful. So it is better if you do not have notebooks, so please make some arrangement, have a paper or two and calculator and pen so that you could do some working alongside me. An entity has a nuclear power plant and a related decommissioning liability. The nuclear power plant started operating on 1st January 2000. The plant has a useful life of 40 years. Its initial cost was $120,000. This included present value of an amount for decommissioning cost of $10,000. The risk-adjusted rate of discount is 5%. The entity financial year ends on 31st December. Assume that a market-based discounted cash flow valuation of 115 is obtained at 31st December 2002. It includes an allowance of 11,600 for decommissioning cost, which represents no change to the original estimate after the unwinding of 3 years discount. The entity adopts the revaluation model in IAS 16. Before moving to the requirement, let's look at some of the information given over here. See, this is the date when this power plant started, and the life is 40 years, and initial cost is 120,000, and it includes this 10,000, because we know that restoration and dismantling cost will become the part of the cost of the asset when initially recognizing. And the discount rate is 5%. See, when we recognize 10,000, I should use another sheet as well. Okay, I can use from here. New blank. Okay, we can see that see 10,000 was the decommissioning cost, so we recognize that cost. Say this is the account for decommissioning cost. Decommissioning cost. Okay, at what date this was? On 1st January 2000. On 1st January 2000. 1st January 2000. 10,000 from like fixed asset account. I'm mentioning it as FA account. Fixed asset account, 10,000 was capitalized within that account. Now, there is a change, if any, in 2002, mean at 31st December 2002. So, mean how many years passed? Like 2000, 2001, and 2002. 3 years. 3 years. So for each year, at the end of each year, you will be increasing this decommissioning liability with the charge for that particular year. So on 31st December 2000, profit and loss account charge will be 10,000 into 5%. It comes to 500. 500 and closing balance on 31st December 2000 is like 10,500. Then the next year, 1st January 2001, opening balance 10,500. Similarly, on 31st December 2001, again this you will be unwinding this amount, 10,500 into 0.5%. So 525. So this will give you the closing balance, and that is 31st December 01. Closing balance will become 11,025. Then is the third year. Opening balance 1st January 2002. Opening balance 11,025. Again, you increase this amount, you unwinded this amount at the rate of 5%. So this will give you 551, and when we add it to the opening balance, this will give you 31st December 2002 closing balance, and that is 11,576. If you go back to our question, it's please note it, 11,576. Our question says, assume a market-based discount rate cash flow, and it says like this is the decommissioning cost. Only small difference, only rounding difference, like 11,576. Here he has taken 600. We have calculated it 11,576, but they have calculated, because question is saying, so we will be taking it as correct because they have rounded this figure, which represents, because question says no change to the original estimate after unwinding of 3 years. How we reach to this figure after unwinding of 3 years? So question has already provided this figure. Okay, the entity adopts a revaluation model in ISA 60. I hope you people understand like how to unwind it, as we already know this. Okay, pass the journal entries to record the transaction for the year ended 31st December 2002. What is the transaction? The transaction is, there is some revaluation, and we know that what will be the double entry for this revaluation. But before that, before that, we need to calculate the revalued amount and revaluation surplus or deficit. See, if we look at this amount, we can see that this was the amount at the start, and at the end of third year, what is the life of this asset? 40 year is the life of this asset. 120 divided by 40, this will give us 3000, mean 3000 as a depreciation per year. Depreciation per year. Depreciation per year is 3000. And for 3 years, accumulated depreciation will be 9000. So this will give us, after deduction of 9000, this will give us 100, I suppose 11,000. Can you check it? Yeah. 11,000. Okay. $111,000. This will give us this amount. Whereas the revalued amount, now we need to calculate the revalued amount. What is revalued amount? Okay, let me raise some of the figures. Revalued amount. What is the revalued amount? Revalued amount is, in fact, revalued amount is 115,000 plus 11,600. This will give us the revalued amount. 115,000 plus 11,600. So this will give us 126,600. So this is the carrying value. This is the carrying value, and this is the revalued amount. The difference between these two is surplus. Surplus we can calculate as 15,000. Surplus is in fact the difference of 126,000 minus, so this will give us 15,600. 15,600. So this is the surplus. And the double entry will be very simple because this is happening for the first time, and this is surplus. So as we discussed yesterday, and you people know it, like this fixed asset will be debit with this amount 15,600, and your other comprehensive income will be credited, and this will go to the revaluation reserve account. 15,600. See, if we just look at what we have done, we have just tried to understand the question, and then we solved the requirement number 1. Mean we calculated the depreciation, no need of explanation. Then we calculated the carrying value, of course, the carrying value at the date of revaluation, which is simply cost minus accumulated depreciation. This gives us the carrying value at the date of revaluation. Then revalued amount is given. Only I did one additional thing. That's what I want to explain to you. Well, see, it is written here, market-based discounted cash flow valuation. This means this figure is calculated on the basis of cash flows. And when you value an asset using cash flow, then of course any dismantling cost is an outflow for that working. So this means you need to add it back in order to reach the revalued amount. If anybody has any question, otherwise I can move further. Please feel free if you have any question. You can ask now, and your question should be relevant to only, because so far as the interpretation one is concerned, please be specific so that we could get maximum benefit from this discussion.
Shiraz Qadir Baksh asking, why are we including 11,600 decommissioning cost in the calculation of surplus? 11,600 is already included in 1,15,000 discounted cash flow.
Qadir Baksh, when we say like this revaluation is done on cash flow basis and decommissioning effect is included in that, this means it has been included in that cash flow as a negative cash flow, as a cash outflow. So in order to calculate for our accounting purpose the revaluation amount, we will have to add that amount in order to reach the revalued amount, as I explained it earlier. Any other question not related to this?
Still people, I think, maybe writing.
Okay.
So kindly explain the cash flow point again. Mariam Alauddin.
Mariam, when question says, or a particular situation says, like this valuation has been done on a cash flow basis, and the effect of decommissioning is included in that calculation. And how that effect is included? That effect is included as a cash outflow within that calculation. So this will give us the valuation on the basis of cash flow. But in order to determine revalued amount for our accounting purpose, we need to add it back, because for us, our asset is not only our cash flows are not only which we will earn, but we will have to incur a cash outflow for that purpose. Within 115, this effect is not there, and we added that effect, though it is written here like discounted cash flow is obtained at 31st December. It includes an allowance. This means includes allowance mean that all the cash flows has been accounted for. Mean you need not to separately adjust it. So this means this figure is revaluation of amount of that asset without the effect of decommissioning. But for our accounting purpose, we add the decommissioning cost in order to calculate the revalued amount.
Mavish Mehman, why not route it through income statement?
Mahesh, this entry is not related to interpretation 1. If you just remember our yesterday discussion or yesterday slides, when a fixed asset is revalued upward first time, you will be crediting the other comprehensive income and your revaluation reserve will increase. Mavish, I hope it is clear. Okay.
Thank you, sir. Sir, one of our member is asking us that if these sessions are being conducted from Lahore or Karachi, please give option to the local residents to attend such sessions by the person.
I think 2 years earlier, 3 years back, when we started this session, this facility was there. Like we used to have a small group of people sitting in front of us, and at the same time that webinar was being telecasted through internet. But for a reason better known to ACCA people, now this practice has been abandoned. But if you think that for local members this can be helpful, this can be beneficial, so please write to our ACCA team. Of course, they will consider this point and will respond accordingly. Okay. Okay. Let's move further. Okay. The next illustration is, okay, the next requirement, in fact, because we have yes, we have completed requirement number 1. Okay, requirement number 2. At 31st December 2003, the discount rate has not changed. However, the entity estimates that as a result of technological advances, the present value of the decommissioning liability has decreased by 5,000. Pass the journal entries to record the transaction. Decommissioning liability has decreased, and they have already made calculation for us. They are giving us the present value of the decommissioning liability. Present value of the decrease, 5,000. When decommissioning liability is decreased, let's go back and see what standard says. See, here we can see that a decrease in liability, shall be recognized in other comprehensive income and increase the revaluation surplus. This means the entry will be, see here you can see that this is the treatment on slide number 34. Liability is decreasing by 5,000. So decommissioning liability will be debited with 5,000 and other comprehensive income will be credited. So revaluation reserve will increase. So the entry will be debit decommissioning liability, debit 5,000 and credit other comprehensive income, and this will increase the revaluation reserve by 5,000. So this is the journal entry when there is a decrease in decommissioning liability for an asset which is being carried at revalued amount. Okay. Okay, now move to a very comprehensive, I hope it is clear as I showed you the slide, and then we made our double entry according to that slide. Okay. Okay, just 1 minute. So I suppose this illustration is also available with you people. Please answer with yes if this illustration is available with you people. This illustration.
Please attention to all attendees. Can you guys see the illustration? Yes.
Okay. See, first of all, we can see its requirement. Its requirement is accounting entries for the year ended 31st March 2011 based on the above information in accordance with the financial ignore taxation. But I will use this information to understand or to revise what we learned from our slides. Okay. Waste Management Limited. Waste Management Limited, WML, had installed installed a plant in 2005 for generation of electricity from garbage collected by the SWIC agencies. WML had signed an agreement with the government for allotment of a plot of land free of cost for 10 years. However, WML has agreed to restore the site at the end of the agreement. Other relevant information is as under. The initial cost of the plant was 80 million. It is estimated that the site restoration cost would amount to rupees 10 million. It is the policy of the company to measure its plant and machinery using the revaluation model. When the plant commenced its operation, that is on April 1st, 2005, the prevailing market-based discount rate was 10%. On March 31st, 2007, the plant was revalued at 70 million, including site restoration cost. On March 31st, 2009, prevailing market-based discount rate had increased to 12%. So you can see that in 2009, there is a change in the decommissioning liability resulting from the change in the discount rate. Because we initially, when we recognized this decommissioning liability at the start of 2005, the discount rate was 10%. Now this discount rate has moved to 12%. So this is a decommissioning liability change. Then again on March 31st, 2011, estimate of site restoration cost was revised to rupees 14 million. Again, there is a change in the decommissioning liability. Earlier, I suppose, yes, this is increasing again. Earlier, it was decreased. Point number 4 related to the decrease of the decommissioning liability, whereas point number 6 related to the increase in the decommissioning liability. Useful life of the plant is 10 years, and WM follows straight line method of depreciation. Appropriate adjustment have been recorded in the prior years up to the March 31st, 2010. We shall start this question and we will discuss year by year till 2011 with the help of journal entries and with the help of relevant accounts. So this will help us in understanding most of the parts of the treatment related to this area. Okay. See, initial cost is 80 million and restoration cost is 10 million. And when we bought this asset on 1st April 2005, then this is important. This is the date when we bought this asset. This is the decommissioning liability, and this is the initial liability. What we will do, we will add into 20 plus this 10 million divided by the discount factor, 1.10%, 1.10 raised to power 10. So this will give us the amount at which the asset is initially recognized. So this will give us 83.8554. So this is the cost of the asset on initial recognition. It has so this will be so we will create two accounts. If this is clear, then we can move further. I hope it is clear. Very simple, 80 plus present value of the 10 million. So this will give us, because we understand from IAS 16 that dismantling or restoration cost will be added to the like other cost. in order to determine the initial value of the asset. Okay.
Sir, can we take questions from last discussion?
No problem. Last discussion mean tomorrow?
Today.
Okay, no problem.
One of our attendees is asking that incremental depreciation is generated due to revaluation. Why is it charged to general fund?
Incremental depreciation is created due to
revaluation.
No, we have not discussed this point.
Okay.
Okay. Any other question? Okay. Okay. Maybe we will be discussing over here. Okay. Now, this means I will try to prepare 3 accounts. Fixed asset account, fixed asset account. Then decommissioning liability, decommissioning and restoration liability. Please, I'm not writing the full name, but this is decommissioning liability. Then accumulated depreciation, just as a reference so that we could treat in case we need that we do not need after a couple of years. Then we can draw over here. Yes, this is revaluation reserve account, revaluation reserve account, revaluation reserve account. So these 2 accounts are important. These 2 accounts are important. Okay. See, if we go back to our question, our question says, like as we have seen here, like this is the amount which should be recognized initially on 1st April 2005. On 1st April 2005, 1st April 2005. Okay. 83.8554. 83.8554. 8554, I made it 86. And decommissioning liability on the same date will be 505 will be fixed asset 3.86. I have taken over here 86. See what happened next. So we treated number 1 point, and then it is a policy of the company to measure its plant and machinery. Plant and machinery using the revaluation model find when the plant commences operation on 1st April, the prevailing market-based discount rate was 10%. That we have used here to determine the present value of the decommissioning liability. Then is on March 31st, 2007, the plant was revalued to 70 million, including site restoration cost. Plant was revalued. So here after 2 years there is a change. So this is a simple revaluation effect. what we will do, we will calculate the depreciation for 2 years. Depreciation for 2 years, because this asset is being held for its life is 10 years. So divided by 10 into 2. So this will give us the depreciation for 2 years. Depreciation for like 06, 07, 2 years depreciation. So this will give us one depreciation 16.772. We are going to use, okay, let me write here the exact date. On 31st December, this was the accumulated depreciation, in fact. December, sorry, it's not December, this is March. Okay. March 07. This was the accumulated depreciation. As for method 2, what we will do, we will transfer it to the fixed asset. 16.772. This will be transferred to the fixed asset, accumulated depreciation on the date of revaluation. My first account is for 2 years. So this will be transferred over here. And what is the revalued amount? That is 70. So this means the closing balance should be 70, revalued amount. And so the revaluation surplus will go to the other comprehensive income. And that is the amount. If we just balance this account, so this will give us 16.77 to 2.912. 2.912. So here we will close 2 years. This account is for 2 years. And decommissioning liability for 2 years, mean for 2006, for 2007. This will be unwinded and the second effect will go to the profit and loss. So I am writing here the closing figure of this liability, mean on 31st March 2007, the closing balance will be 3.86 into 1.1 into 1.1, because I am giving 2 years effect. So this will give us 46706. And similarly here in revaluation reserve, you will see that 31st March 2007. This will give us like from fixed asset account 2.912, because this is the last day of this particular year. So the same will be the closing balance. The same will be the closing balance. December 07, closing balance will be 2.912. And then opening balance of the next year 7, opening balance 2.912. And similarly, you can see that the opening balance for accumulated depreciation, which we do not need further, 1st April 07, opening balance will be 0. And decommissioning liability opening balance will become 1st April 2007, opening balance will become 4.6706. Okay, these are the balances. 4.6667. Okay, 6706. Okay, fine. Now I hope it should be clear. Simply I recorded the decommissioning liability, and I unwinded it for 2 years. So this gave me this figure, and all these are basically the effect of the revaluation surplus, because this revaluation took place at the year end at 31st March 2007. So you can see that no depreciation is calculated, and similarly no amount is transferred from revaluation reserve to the retained earning. We are assuming that this company has a policy of transferring revaluation reserve to the retained earning in the pattern of depreciation. Anyway, so this is the opening balance here also. Now, what happened next? See, we have treated till point number 4. On March 31st, 2009, prevailing market-based discount rate had increased to 12%. Now, this is happening on 31st March 2009, mean after 2 years. What happened? Instead of 10%, the discount rate has moved to the 12%. Mr. Khayyam, can you see if we have any questions so far before I moving it to
we
this?
have one question from Burhanuddin.
Yes, Burhan.
He said, why does the decrease in decommissioning liability not affecting the cost of nuclear plant, as it is part of cost of nuclear plant?
Because, Burhan, this asset, like you are using in fact revaluation model for this asset, and this revaluation related to that asset. So any effect of this decrease will go to the revaluation surplus. Okay, now this has moved to the 12%. Now how we will treat it? We will, first of all, now we will focus on this decommissioning liability and revaluation reserve. Okay, there is a okay, this is decommissioning liability. This is decommissioning liability. If we unwind it on 31st March 2008 and on 31st March 2009, the effect for 2 years will be by using 10% discount rate. So the effect will be 4.6706. So the effect will be, cumulative effect of these two will be 0.9808. This will be the cumulative effect of unwinding. And similarly, if we, this is the revaluation reserve account. If we transfer a part of revaluation reserve to the retained earning, over a period of 2 years, then the amount will be like first we have transferred on 31st March 08 and 31st March 09, how much? because on 1st April 2007, 8 years is the remaining life of this asset. So 2.912 divided by 8, this will give us 0.364, and for 2 years this will give us 0.728. This will go to the retained earnings. This will go to the retained earnings. Okay, now what happened? This 10 million without discount was the decommissioning liability, and the discount rate was used 10%. Now this discount rate has moved to 12% at what date? At 31st March 2009. And we bought this asset on 1st April 2005. So this means the remaining life of the asset is like 6, 7, 8, 9, 6 years are remaining. Mean this 10 million will be paid after 6 years from 31st March 2009. So what we will do, we will discount it 10 million using this revised discount rate. Revised discount rate. So this will give us 5. This will give us 5.066. It should be the closing balance. From here, we have calculated this amount. This should be the closing balance on 31st March 09. Now two sides will not balance. We can see that whether there is an increase or decrease, like 4.6706 plus 4.06706, 4.6706 plus 0.9808. This will give us 5.6. Total of these two amount is 5.6514. So this means our liability is, decommissioning liability is decreasing. Both sides should be 5.6514. Our liability is decreasing by 5.066 by 0.5854. So this is the amount by which our liability is decreasing. And we know from our slide, like if there is a decrease in liability, if there is a decrease in the liability, this effect will go to the revaluation surplus. This effect will go to the revaluation surplus. Okay, let's go back. So the entry will be, here the entry will be debit decommissioning liability 0.5854 credit. Other comprehensive income mean this will go to the revaluation reserve because it is there 5854. So we shall be recording this amount over here because it is being credited. So we shall credit on 31st March 07 against decommissioning liability. How much? 0.5854. So now the closing balance of revaluation reserve will become 2.912 plus 0.585 minus 0.7. So this will give us 2.7712. Let me confirm it. 5.06. Okay, fine. This is okay. And then revaluation reserve is 2.77. Okay, fine. A little rounding difference somewhere. So I hope this calculation is clear before moving, because now I'll be using new accounts and starting from 1st April 2007, because already there are a lot of figures. It's very simple. Here liability is decreasing. Simply, if there is a revaluation surplus, credit the revaluation, mean other comprehensive. See, revaluation surplus, credit the revaluation surplus. Except that it shall be recognized to the extent that it reverses a revaluation deficit on the asset that was previously recognized in profit and loss. So this is the total material related to the decrease in decommissioning liability. If we have any question, we can take it now. Otherwise, we can move further.
We have a question, but this relates to our previous slides.
Yesterday's
Mohammed
slides?
Aziz Siddiqui asking, will OCI amount also go to the revaluation reserve on equity side in statement of financial position?
Yes. Yes, Asid. Normally, you people used to write revaluation reserve credit. But the appropriate way is when passing journal entry, you should credit OCI, and that OCI is basically will go to the revaluation reserve account in equity.
Shiraz Khatir Baksh, please tell me how you calculated 0.908 unwinding of discount.
0.9808. Kadir Baksh, see, 4.6706 was the decommissioning balance on 1st April 2007. Then what I did, I just unwinded with 10%, and for 2008 and 2009, and then I added up these two amounts. Like if I just calculate 4.6706 into 0.1, this 0.46706. If I mention separately over here, by putting box over here, I hope other member will not confuse. So for 2008, this is 0.467. And this 0.46706 will be added to the 4.6706 to reach the closing balance on 31st March 2008. And then again, I unwinded it with 10%. So this will give us 0.514 something. So instead of writing them separately, I wrote one cumulative figure. Kadir Baksh, I hope it is clear. Simply unwinding 2008, 2009, I added them up. Kadir Baksh, I hope it is
not responded. However, I would like to request all the attendees to kindly send clear and complete questions rather sending vague questions. In question section, one of our attendees, Shazad Khuram, asking 31st March 2009 should be in RR.
Should be
in RR. It doesn't make any sense. 31. If RR is revaluation reserve, then what it has to do with 31st March 2009? 31st March 2009 should be in RR.
If you ask clear question, so this will help us in answering you in one go. And similarly, you should ask your question in one go instead of writing your question in parts. Take your time, write your question in one go, and then send it to us. So this will enhance our understanding of your question, and of course, this will mean we can answer it in the right context.
Mohammed Rehan Tahir, can you tell again for 0.728 how it was calculated?
0.728. Rehan, simply if you look at it, we have this is the yes, this one. This is the this one. This is the opening balance of the revaluation reserve, and company policy is to transfer a part of this revaluation reserve to the retained earning. And instead of calculating for 2008 separately and 2009 separately, I added them up. For example, if you just calculate separately, like 2.912 is the revaluation reserve. What is the remaining life from 1st April 2007? 8, 9, 10, 11, mean 8 years are the remaining life. 8 years is the remaining life. So you will be dividing it by 8. So this will give you 0.364 for 2008 and similarly 0.364 for 2009. So when you add them up, so this will give you 0.72. Here it should be, I think, 9. Yes, it should be 9. Yes. I hope it should be clear. This is simply when you transfer your revaluation reserve to the retained earning. What I did, I simply calculated for each year because I was preparing this account for 2 years. I added two years figures to reach 0.728. You simply divide 2.912 by 8. Okay, should we move further?
Yes, I.
Okay. Now we go back to the question, but before going back to the question, I would like to again mention over here, prepare again these two accounts, decommissioning account, decommissioning account on 1st April 2009. Our opening balance is 5.066, and in case of revaluation reserve on 1st April revaluation reserve 1st April 2009, as we can see from the top, it is 2.7712. Okay, now go back to the question. The question is, we have solved this question till point number 5. On March 31st, 2011, again after 2 years, estimate of site restoration cost was revised to 14 million. So again, there is a change. after 2 years. Okay, first of all, we shall calculate, we shall give the effect of 2 years. What is the effect of 2 years? We shall unwind decommissioning liability by 2 years. At what rate? 12%, because now the rate is 12%. How can we do that? Now I'll be doing it separately, so that there should not be any confusion. Okay. On 31st March 2010, unwinding effect will go to the profit and loss account at the rate of 12%. I will be multiplying 5.066 into 0.12. So this will give us 0.60792. And we can close this year on 31st March 2010, and this will give us 5.066. This will give us 5.6739. So now I'm doing it separately so that we could move quickly. Then opening balance on 1st April 2010 will become 5.6739. Again, effect of unwinding, 31st March 2011. The 1st March 2011. Profit and loss. Again, I will be multiplying 5.6739 with 0.12, 12%, which is the new discount rate. So this will give me 0.68087. Likewise, I'll keep on transferring this revaluation reserve to the retained earning. Okay, what was the closing balance of this revaluation reserve? Let me verify this. 2.7. Okay, fine, it is fine. So on 31st March 2010, 0.364, as we calculated earlier, will be transferred to the retained earning, and the closing balance on this date of revaluation reserve will become 2.7712 minus 0.364. So this will give us 2.4072, in fact, 2. Opening balance 2010. Opening balance 2.4072. Again, on 31st March 2011, 0.364 will be transferred to retained earning. Now, at this date, 31st March 2011, there is a change in decommissioning liability. What I did before accounting for the change in decommissioning liability, I made my accounts to that point, to that date. Okay. Now what happened? as we can see from the question. Question says now the estimate of site restoration cost is 14 million. Okay, no problem. 14 million. This means initial estimate was 10 million, and which was discounted at 10%, and subsequently it was discounted at 12%, and we made that adjustment. Now what happened? There is a revision to this estimate. Now it is 14 million at 31st March 11. At 31st March 11, and the discount rate is 12%. Now we will recalculate the decommissioning liability. How? 14 million divided by discount rate 1.12 raised to par the remaining life. And what is the remaining life? Because we bought this asset on 1st April 2005, that means 6, 7, 8, 9, 10, 11. 4 years, the remaining life is 4 years. So this will give us 4 years is the remaining life. This will give us in 2011 8.899 million. So this means this is the closing balance. 31st March after this revision to 2011. This is the closing balance, 8.899. Both sides should balance. So we shall make a total of these two sides, and we find that this side looks higher. See, 5.6 plus 0.68. This is not a higher amount. So this should be the total if it is a higher amount, and this should be the total, 8.899. So what is the difference? The difference is 8.899 minus 5.6739 minus 0.68087. So this will give us, the difference is in fact 2.54423. So what will be the double entry for this? See here, decommissioning liability is increasing. So decommissioning liability, of course, will be credited with this amount. So I can make this entry over here, decommissioning liability. Decommissioning liability, okay, I'll make it L. Decommissioning liability account 2.54423. And what about debit? For debit, we can go back to our slide. Our slide says, if there is an increase, shall be recognized in profit or loss. Shall be recognized in profit, except that it shall be recognized in the other comprehensive income and reduce the revaluation surplus, because there is a revaluation surplus. So first, this will make that revaluation surplus 0. So our entry will be debit. This revaluation surplus of course, through other comprehensive income. Other comprehensive income, revaluation reserve. So what is the balance within this account? It is 2.4072 minus 0.364. So this means we have 2.5 out of this 2.5, because this asset has got revaluation surplus, so we will debit the revaluation surplus with this amount, which is the total revaluation surplus related to this asset. But still there is a difference. The remaining amount will be debited to the balancing figure, will go to the profit and loss account, as we have seen from our slide 2.54423. Point 5013. So this way, when we will record it over here, so you can see that revaluation reserve is being debited. So debit side is this 2.0432 against decommissioning liability. So this account will become nil. Here, two amounts will appear. Decommissioning liability is being credited 2.0432, 0.5013 against OCI, mean revaluation reserve, and then profit and loss. So this is the treatment of increase. This is simply the treatment of increase in liability. And now your revaluation decommissioning liability is 8.899. 8.899. If anybody has any question, then I can answer those questions, and thereafter we can have a prayer break. No, I have a few more slides related to this. Then we can go for a sir. Yes.
No, thanks, Mr. Sakib. Asking, at the time of revaluation, you are transferring the accumulated depreciation to fixed assets account. However, in depreciation schedule, the assets is already reflected after deduction of accumulated depreciation as its WDV. Are you doing this to transfer WDV as a cost?
Who is the gentleman?
Mr. Sakib Ali Rashid.
Mr. Sakib, this is method 2 in fact. When there is a revaluation under method 2, because we discussed method 1 and method 2 yesterday. Under method 2, simply transfer your accumulated depreciation related to that asset to its cost account. This will bring that asset to its WD. And then thereafter compare this value with the revalued amount and pass the entry to give the effect of that revaluation. So this is method 2, but at the end of the day that will not affect. Okay, any other question, please?
No more questions.
Okay, so this was this is all about interpretation 1. If we go back to our slide, we have seen this illustration, and then for both cost model and devaluation model, the adjusted depreciable amount of the asset is depreciated over its useful life. Therefore, once the related asset has reached the end of its useful life, all subsequent changes in the liability shall be recognized in profit or loss as they occur. This applies under both the cost model and the revaluation model. The periodic unwinding of the discount shall be recognized in profit or loss as finance cost as it occurs. Capitalization under International Accounting Standard 23 is not permitted. Uh, this we discussed. And I have included its answer, but in a separate, in a different format. Anyway, I will be sending you the typed answer of this question as well. The important thing is you need to learn when there is an increase and when there is a decrease. What should be the journal entries? Once journal entries, once you are comfortable with the journal entries, the rest is easy. That is not an issue. Okay. So this is the derecognition of the fixed asset, and now we move to International Accounting Standard 36. Don't worry, I can understand that last case study was a lengthy one. I shall be sending you this write-up as well as the typed answer with journal entries of this illustration. That will make your concept more clear if you find some time to go through it again. Okay, now we shall go for a sub prayer break. Thereafter, we will have a look at International Accounting Standard 36. Okay, welcome back. International Accounting Standard 36, impairment of asset. In this standard, is applicable to tangible, intangible, and financial assets, except inventories, assets arising from construction contracts, deferred tax asset arising from arising under International Accounting Standard 19, employees' benefits, financial assets within the scope of International Accounting Standard 32, financial instrument presentation. This is because those ISAs, IAS already have rules for recognizing and measuring impairment. So that's why in point number 2 you can see those assets on which requirement of International Accounting Standard 36 will not be applicable. Further note that International Accounting Standard 36 does not apply to non-current asset held for sale, which are dealt with under IFRS 5. Okay, we shall try to answer these 3 main issues. Number 1, how is it possible to identify when an impairment may have occurred? How should the recoverable amount of the asset be measured, and how should an impairment loss be reported in the accounts? Okay, first question. Yes, you people know from your earlier study as well, because there is no much change in this standard, that there could be internal factors, there could be external factors causing impairment of your asset, and there are assets for which standard requires that you need not to wait for the indications. You are required to test them for impairment annually. But for other assets, standard requires you that there should be indications, there should be internal or external indications which should trigger the impairment testing. An entity should assess at the end of each reporting period whether there are any indications of impairment to any assets. The concept of materiality applies, and only material impairment needs to be identified. If there are indications of possible impairment, the entity is required to make a formal estimate of the recoverable amount of the assets. 36 suggests that the indication of a possible impairment of asset might be recognized. The suggestions are largely on common sense, like external source, a fall in the assets market value that is more significant than would normally be expected from passage of time over normal use, a significant change in the technological, market, legal, or economic environment of the business in which the assets are employed. Like for one of our client, a subsidiary of Wholesale, there was an indication of impairment of their fixed asset because a competitor emerged, and company was unable to compete with that competitor. Reason being, there was a huge difference between the price being charged by the Wholesale and the price being charged by the competitor. So in fact, a couple of hundred real was a difference. So this was a big difference, and Wholesale was not in a position to reduce its price to the extent where it can match its cement bag price to the local competitor. So this was an indication of the impairment of the fixed asset of the factory. Then an increase in market interest rates or market rates of return on investment likely to affect the discount rate used in calculating value in use, the carrying amount of the entity's net assets being more than its market capitalization. Then internal sources of information, evidence of obsolescence or physical damage, adverse changes, and likewise. See, as I mentioned earlier, even if there are no indications of impairment, the following asset must always be tested for impairment annually. An intangible asset with an indefinite useful life. Goodwill acquired in a business combination. Okay, the next question is, how should the recoverable amount of the asset be measured? The recoverable amount of an asset should be measured as the higher value of the asset's fair value less cost of disposal and its value in use. An asset's fair value less cost of disposal. Okay. This is the price that would be received to sell the asset in an orderly transaction between market participant at the measurement date, less direct disposal costs such as legal expenses. If there is an active market in the asset, the fair value should be based on the market price or on the price of recent transaction in similar assets. If there is no active market in the asset, it might be possible to estimate fair value using best estimates of what market participant might pay in an orderly transactions. Fair value less cost of disposal cannot be reduced, however, by including within cost of disposal any restructuring or reorganization expenses or any costs that have already been recognized in accounts as liability. Then value in use is basically the present value of the estimated future cash flows generated by the asset, including its estimated net disposal value, if any, at the end of its expected useful life. How should an impairment loss be reported in the accounts? The rule for asset at historical cost is, if the recoverable amount of an asset is lower than the carrying amount, the carrying amount should be reduced by the difference. And this difference is termed as impairment loss, which should be charged as an expense in profit or loss. Loss is not mentioned over here, of course, in profit or loss account. But if asset is held at a revalued amount, then impairment loss is to be treated as revaluation decrease under the relevant IAS, of course, IAS 60. This means to the extent that there is a revaluation surplus held in respect of the asset, the impairment loss should be charged to revaluation surplus. Any excess should be charged to the profit or loss. Then is, no, there could be assets for which it is difficult to calculate the recoverable amount. Because what is recoverable amount? Recoverable amount is the higher of fair value less cost of disposal and value in use. Like you may have an asset which that does not generate cash flows, so value in use cannot be determined, and similarly it may have insignificant selling price. So the calculation of the recoverable amount is not possible for that asset. In that case, what need to be done? You need to club that asset with such smallest identifiable group of asset for which independent cash flows can be identified and measured. There are many examples. There are many, but the key principle is, which is important for us. The key principle is independent cash flows that can be identified and measured. For example, a mining company owns a private railway that it uses to transport output from one of its mines. The railway now has no market value other than as scrap, and it is impossible to identify any separate cash inflows with the use of the railway itself. Consequently, if the mining company suspects an impairment in the value of the railway, it should treat the mine as a whole as a cash generating unit and measure the recoverable amount of the mine as a whole. So that railway will be clubbed with the mine, and this will become the smallest identifiable group of assets from which independent cash flows are being generated. So this is the concept of the cash generating unit, where it is not possible to calculate the recoverable amount of a single asset, then that asset should be included in some cash generating unit. Another example, and these examples are taken from the standard. A bus company, see, the key point will be in significant generation of independent cash flows. Significant generation of independent cash flows. Like a bus company has an arrangement with a town's authorities to run a bus service on 4 routes in the town. Separately identifiable assets are allocated to each of the bus routes, and cash inflows and outflows can be attributed to each individual route. 3 routes are running at a profit and 1 is running at a loss. The bus company suspects that there is an impairment of assets on the loss-making route. However, the company will be unable to close the loss-making route because it is under an obligation to operate all 4 routes as part of its contract with the local authority. Consequently, the company should treat all 4 bus routes together as a cash generating unit and calculate the recoverable amount for the unit as a whole. Because you cannot operate any of the bus route independently. You will have to operate the other routes. So this means any of that route cannot generate cash inflows which are largely independent from the other routes. Another is mini mart. Again, I will repeat, it does not matter if how these assets are being managed internally, what is their purchasing policy, what is their marketing policy. The key concept is, or the key point is, which will be used in deciding about the smallest group of those assets which can become a cash generating unit is generation of independent cash flow, largely independent cash flows. See, in Minimart, in this example, Minimart belongs to a retail store chain, Maximart. Minimart makes all of its retail purchases through Maximart's purchasing center. Pricing, marketing, advertising, and human resource policies, except for hiring Minimart cashiers and salesmen, are decided by Maximart. Maximart also owns 5 other stores in the same city as Minimart, although in different neighborhoods, and 20 other stores in other cities. Sorry, all stores are managed in the same way as Minimart is managed. Minimart and 4 other stores were purchased 5 years ago, and goodwill was recognized. All Maximart stores are in different neighborhoods and probably have different customer bases. So although Minimart is managed at a corporate level, Minimart generates cash inflows that are largely independent from those of Maximart's other stores. Therefore, it is likely that Minimart is a cash generating unit. See, how you are managing those stores internally is not important. The important thing is cash flows, significant cash flows. If you have store one in one area, another in area 2, third one in area 3, when you advertise all these stores as a whole. But in fact, each store has a customer base. which is largely independent. I would not say absolutely independent, largely independent from the customer base of the other store. So that's why, regardless how these stores are being managed internally, you will be looking at the criteria like generation of largely independent cash flows. If this generation is there, that smallest group will become cash generating unit. Okay. If an active market exists for the output produced by the asset or a group of assets, this asset or group should be identified as a cash generating unit, even if some or all of the output is used internally. This means if a group of assets can generate largely independent cash flow, whether it is generating or not, this is not the consideration. The consideration is, does this smallest group has the ability? If the answer is yes, then this smallest group of asset will become cash generating unit. Cash generating units should be identified consistently from period to period for the same type of asset, unless a change is justified. The group of net assets less liabilities that are considered for impairment should be the same as those considered in the calculation of the recoverable amount. Okay. Next is, okay, before going to the next concept, if we have any questions.
We have some questions. We have some questions, but I think this relates to our previous discussion, not this one. Sukana Fatma asking, according to IAS 16, excess depreciation is transferred from revaluation reserve to retained earning. In this case, we have transferred 0.364 each year. However, due to reversal of revaluation surplus on account of increase in decommission liability, we will not be able to transfer excess depreciation to retained earning. So isn't it contradictory with IAS 16?
No, this is not contradictory. Sukana, your first comment, like we transfer from revaluation reserve to the accumulated depreciation, this is not correct. In fact, you transfer from revaluation reserve to the retained earning, an amount roughly equal to the additional depreciation. An amount equal to the additional depreciation. That's what we did in our answer. However, the neat answer, typed answer will be sent to you people. But for the rest of your question, see, International Accounting Standard 16 does not directly address the accounting of decommissioning or restoration subsequent to the initial measurement. So that's why there was a need of this interpretation. So this interpretation basically addresses the change in decommissioning or restoration liability subsequently. Any question?
Kindly re-elaborate more on the amount of revaluation reserve that was being transferred to retained earnings constantly. Muhammad Aziz.
Muhammad Asjad, can we have flash? Can we have flash? I can show you the typed answer that may be helpful for that. Asjad, I'll be sending you people the typed answer, and there you will find general entries and transfer to the revaluation reserve and transfer from the revaluation reserve. Thereafter, you can I hope that will automatically solve your question. If you have any specific question related to any specific figure, yes.
I think we should provide them your email ID.
Yes, as I mentioned yesterday, my email ID.
Please let me know
yes,
when to everyone.
email ID is Abubakar, ABUBAKAR, at the rate of Baker Tilly, BAKER, MIQ.com.
Okay.
So
I send
once
the email to everyone.
Okay, once you receive the typed solution of this illustration, then you can ask question related to any specific figure. So that I can answer, because we already have taken a lot of time on that illustration.
What discount rate should be used to calculate present value of future cash flows for computation of value in use? Asked by Sukena.
I suppose this we discuss somewhere. I suppose we discussed this somewhere. Value in use. Assets value in use. Normally, cost of capital is used, but this is basically yes. Normally, cost of capital is used, but so far as the cash flows are concerned, just because I need to discuss other point as well. That's why I kept it short. Only that growth rate should be like decrease after 5 years, or there should not be any growth after 5 years. So can I hope it should be clear.
Hamid Akram asking, what is the difference between impairment and revaluation loss? Revaluation loss deficit. If you would please highlight the difference in presentation disclosure of both.
What's his name?
Hamid Akram.
Hamid, when you calculate impairment on an asset where you are using revaluation model, that impairment will be treated as a revaluation decrease. Simply revaluation decrease. Only the difference is when you calculate the fair value, for impairment purpose, what you do, fair value less cost of disposal. But in case of revaluation model, when you calculate the fair value, there is no reduction of like this cost of disposal. The only difference is of cost of disposal. For example, there are indications of impairment of an asset which is being kept at revaluation. So instead of calculation, you will be simply calculating like its recoverable amount. Recoverable amount will be the higher. Value in use and the fair value less cost of disposal. So if there is any impairment, you will be treating it as revaluation deficit, because an asset could be devalued without it is not necessary that an asset is impaired if there is a revaluation deficit, because revaluation deficit is purely based on the fair value. Impairment is based on the higher of these two figures. Maybe fair value is lower, but if value in use is higher, then that asset is not impaired in fact. That asset is not impaired in fact. So this is the small difference, but so far as the accounting treatment is concerned, that is very simple. If there is an impairment on an asset being kept at revaluation, then you will treat it as you do you treat the revaluation deficit. I hope it should be clear. Next.
Mohammed Saqib Ali Rashidi asking, at the time of revaluation, you are transferring the accumulated depreciation to fixed asset account. However, in depreciation schedule, the asset is already reflected after deduction of accumulated depreciation as its written down value. Are you doing this to transfer written down value as a cost?
No, Sakib. Okay, I suppose we have answer here. See, in this answer, so this is not written down value. This is the initial cost on 1st April 2005. And this is the accumulated depreciation for 2 years. This account is meant for 2 years, Sakib. So this is not a written down value. Now the revalued amount of this asset at the end of 2 years is 70. Of course, 70 will be the closing balance. So this is the revaluation surplus. Sakib, I hope it should be clear because this is not a written down value. What I did when I used method 2, if you just go back to our slide of yesterday's session, you will find that this is as per method 2. What you did, you transferred this amount from here to here just to bring this amount to the net book value. Then you compare the net of these two with 70. This will give you the difference of 2.91. Sakib, I hope it should be clear. Okay.
No more questions.
Okay. We were here. Cash generating unit. Allocation of goodwill to cash generating unit. Goodwill acquired in a business combination does not generate cash flows independently of other asset. It must be allocated to each of the acquirer's cash generating units or groups of cash generating unit that is expected to benefit from the synergies of the combination. Each unit to which the goodwill is so allocated should represent the lowest level within the entity at which the goodwill is monitored for internal management purposes, not be larger than a reporting segment determined in accordance with IFRS 8 operating segments. See, small example here. Testing cash generating unit with goodwill for impairment. The annual impairment test may be performed at any time during an accounting period, but must be performed at the same time every year. Building 30 million, plant and equipment 6 million, goodwill 10 million, current assets 20 million. So this will give us 66 million. Following a recession, an impairment review has estimated the recoverable amount of the cash generating unit to be 50 million. How do we calculate the impairment loss? How do we calculate the impairment loss? I think people should try to calculate it because this is very simple and basically we are refreshing this standard. I mean, a lot of changes are there in other standard, but hardly any change except if any in this International Accounting Standard 36. Okay.
In the meantime, I must convey thanks from Mr. Sakib.
Welcome,
on the point you have
Sakib.
explained.
Okay, welcome, Sakib. This is the solution. Here you can see that, in fact, this was basically like this is the carrying amount 66, and this was the impairment loss. If we just go back to small illustration, this is the carrying amount of the asset, and this is its recoverable amount. So there is an impairment of 16. Here you can see that this is the impairment loss. No amount will be allocated to the current asset. And first of all, we will allocate impairment loss to the goodwill. And the goodwill becomes 0. And the remaining 6 is allocated between these two assets on a pro rata basis. So after allocation of impairment, this is the carrying value of the asset. Accounting treatment of impairment loss. Individual asset we know, like the carrying amount should be reduced to recoverable amount in the statement of financial position. The impairment loss should be recognized immediately in profit or loss until the asset has been revalued, in which case the loss is treated as a revaluation decrease. We discussed it earlier as well. After reducing an asset to its recoverable amount, the depreciation charge on the asset should then be based on its new carrying amount. This is very important point. This is rather, I would say, practical point. Please remember few things. Remember few things. Like when you in fact so when you, like for example, when there is a change in the carrying value of the asset, it could be due to revaluation, it could be due to like impairment, or revaluation could be surplus or deficit. Now the depreciation will not be based on the original cost. The depreciation will be based on this new carrying value. This is important. Like what is the mistake? Like for example, you have a fixed asset of $10,000. This was the cost initially. Like it has got life of 10 years. 10 years. And this is in fact a piece of land, just to, okay, no, on land we do not charge depreciation. Okay. After 2 years, or at the end of 2 year, second year, its carrying value is 8,000. Its carrying value is 8,000. If we are using straight line method. If it is revalued to upward, like it reaches to 12,000. Now, if you are using straight line method, don't assume that you will be calculating depreciation on this. No, this is the new value which will be used for the calculation of the depreciation, and you will be using the remaining amount, which is 8 years in this case. Similarly, when an asset is impaired, after impairment, whatever is the carrying value, that will be used and the remaining life will be used. So this is important point. I have noted that our colleague normally made mistake in this area. Okay. Okay. So this was the point. Like after reducing an asset to its recoverable amount, the depreciation charge on the asset should be based on its new carrying amount, its estimated residual value, if and its estimated remaining useful life. So this is very important. This is not only in case of impairment. As I mentioned, it should be this concept will also apply in case of revaluation surplus, whether it is revaluation surplus or deficit. Then is an impairment loss should be recognized for a cash generating unit if and only if the recoverable amount for cash generating unit is less than the carrying amount in the statement of financial position for all the assets in the unit. When an impairment loss is recognized for a cash generating unit, the loss should be allocated between the assets in the unit in the following order. This order is important. First, to any asset, to assets that are obviously damaged or destroyed. Next to goodwill, allocated to the cash generating unit, and then to other assets in a cash generating unit on a pro rata basis. So this, in cash generating unit, this pattern is very important. But while you are allocating impairment loss to the asset, so make sure you should not reduce that asset below the highest of its fair value, less cost of disposal, its value in use, and zero. I mean, you cannot make asset negative, but if it can be sold for some value, even then you should not reduce that asset below that value. So highest of these three figures. Any remaining amount of an impairment loss should be recognized as a liability if required by other ISAs. Otherwise, this will be lost. Okay, this is a small example. Okay, this you can try to you can take it as a pop-up question. I can give you people option. This slide is in front of you. Carefully read it. Make up your mind or do the calculations, and then we will pop up question related to this example with a couple of options. So from there you can choose an option which matches your answer. The example is, Khayyam, we should be ready for pop-up question. Okay, but first this example is in front of them so that they could solve it. A company that extracts natural gas and oil has a drilling platform in Caspian Sea. It is required by legislation of the country concerned to remove and dismantle the platform at the end of its useful life. Accordingly, the company has included an amount in its account for removal and dismantling cost and is depreciating this amount over its platform expected life. The company is carrying out an exercise to establish whether there has been an impairment of the platform. Its carrying amount in the statement of financial position is 3 million. The company has received an offer of 2.8 million for the platform from another oil company. The bidder would take over the responsibility and cost for dismantling and removing the platform at the end of its life. The present value of the estimated cash flows from the platform's continued use is 3.3 million before adjusting for dismantling cost. The carrying amount in the statement of financial position for the provision for dismantling and removal is currently 0.6 million. What should be the value of drilling platform in the statement of financial position, and what, if anything, is the impairment loss? Okay, please do the calculations. Calculate the impairment loss. So you have 1 more minute, then we will pop up question with
point 3.
no, don't write this thing in the comment. Okay, we are going to pop up a question related to this. Can you please pop up a question? Write 3 options. Impairment loss is equal to. This will be the statement. Okay. And option 1 is, as Fateh Fakhri said, 0.3. Option 1. Option 2, 0. Option 3,
Yes.
0.2 million. All figures are in million. 0.2.
Okay. I'm going to launch the poll, so
Yes.
All the attendees are requested to participate in this poll. Here we go. I think they should be allowed 1.5 minutes. So we have left with 1 minute now. Please participate more. So far, 16% people have voted. Only 30 seconds left. So far, 21% have voted. Please, I request you all to please participate. Thank you. Okay, so I am going to close this poll now. Around 42% people said that 0.02, 0.2, 20% people saying 0, and 37% people saying 0.3.
Anyway, this is good. Majority is correct. 42% people are correct. You can see over here. See, value in use, present value of cash flows from use less the carrying value of the provision liability. This is value in use, in fact. And that is 2.7. And its fair value less cost of disposal is 2.8. So the higher of these two figures is in fact 2.8. Carrying value is 3 million. So there is an impairment of 0.2. So this was the answer. Okay. Next small question is, a company has acquired another business for 4.5 million. Tangible assets are valued at 4 million and goodwill at 0.5 million. The asset with a carrying value of 1 million is destroyed in a terrorist attack. The asset was not insured. The loss of the asset without insurance has prompted the company to assess whether there has been an impairment of asset in the acquired business and what the amount of any such loss is. Okay, the recoverable amount of the business is measured as 3.1. Okay, and this is the second pop-up question, a very small question. Please solve it. Please mention the impairment loss. Calculate the impairment loss, in fact. Very simple, very simple.
Impairment loss.
Calculate the impairment loss.
Okay, answer should be
very, very simple. Answer is zero impairment loss, zero mean.
Okay.
And second is uh, 1.1 million.
1.1 million.
Yes.
Okay.
And third option is 1.4 million.
Okay.
Give them 1 minute before launching your pop-up question.
Attention, please, all attendees. I'm going to launch this poll, so you have only 1 minute for this poll now.
No, just hold for a couple of seconds so that we can see the question carefully. Anyway, we have launched it.
Yes, we have launched it. The question is calculate the impairment loss. Please select one.
Can we pause this pop-up question so that they could see 3-4 lines carefully before answering this pop-up question?
In other pop-up questions, we can offer them some statement in our answers section. So far, only 11% people have voted, and I think 30 seconds left now. The participation is way below than the last poll question. People are encouraged to participate more. So far, only 19% now. I think I must close now.
Yes.
Okay. Anyone's left? Okay, I'm going to close it now. 42% people saying B, 1.1 million. 41% saying C, 1.4 million. And 17% people saying 0.
Okay, the answer is in front of you. I would not comment anything on this because this was quite straightforward. I just created option just to check the strength of the concept. But anyway, there has been an impairment loss of 1.4 million, 4.5 million, minus 3.5 million. If you just look at the question, you can see that this is in fact this is the carrying value of the business, and this is the recoverable amount. Because recoverable amount is lower than the carrying amount. This information will be used while allocating the impairment loss. This information is not related to the calculation of the impairment loss. Calculation of the impairment loss is very simple. This is basically the difference of carrying value and the recoverable amount. Carrying value is 4.5 million and recoverable amount is 3.1 million. So this is the answer which is in front of you. There has been an impairment loss of 1.4 million. 4.5 million minus 3.1 million. The impairment loss will be recognized in profit or loss. The loss will be allocated between the assets in the cash generating unit as follows. A loss of 1 million can be attributed directly to the uninsured asset that has been destroyed. The remaining loss of 0.4 million should be allocated to goodwill. The carrying value of the asset will now be 3 million for the tangible assets and 0.1 million for the goodwill. Okay, reversal of impairment. If anybody has any question related to this example, I can, but if it is clear, because the answer is self-explanatory and it has been
charge for impairment assets sequence loss charge to goodwill be only case of consolidation by Usman Iqbal. I don't think it make any sense. I have requested time and again that please you guys should pose clear questions. If we are having questions like this, we will be wasting our time.
Okay, I suppose because we are discussing a very basic standard and which is quite straightforward. Only when we receive like wrong answer of 42%, this is just because like we could not focus on what we are solving. But otherwise, I believe that you people are comfortable with this standard. Okay.
Zishan Tour asking, is impairment the only way to de-recognize the asset if it is destroyed?
Yes, if it is destroyed, then this will be de-recognized, of course. This will be de-recognized.
Can you re-explain the rule of the allocation, the impairment loss between the tangible assets and goodwill?
Yes, I can repeat that rule.
Fateh.
Fateh, the rule is, Fateh Fakhri?
Yes.
Fateh, the rule is, here this slide is in front of you. An impairment loss should be recognized for a cash generating unit if and only if the recoverable amount for the cash generating unit is less than the carrying amount in the statement of financial position for all the assets. Yes, is less than the carrying amount in the statement of financial position for all the assets in the unit. When an impairment loss is recognized for a cash generating unit, the loss should be allocated between the assets in the unit in the following order. Number one, first, destroyed assets or damaged assets. If still impairment loss is there, then this will be allocated to the goodwill. And the remaining amount of impairment loss will be allocated to all other assets on a pro rata basis. But be careful while allocating impairment loss to other assets on a pro rata basis. So the carrying amount of that asset should not be reduced below the highest of its fair value less cost of disposal, its value in use, and zero. But this is applicable to all above. Like if something is destroyed, but that can be sold for some amount, so that amount should not be reduced below that price. So this is the principle. Fateh, I hope now you refreshed. I understand this is something not new, but now you can revise or refresh your memories of International Accounting Standard 36. So this is the principle. Okay, we can move.
He's saying thanks to you.
You're welcome, Hati. Okay. Next is reversal of an impairment loss. Reversal of an impairment loss. See, the annual assessment to determine whether there may have been some impairment should be applied to all assets, including assets that have already been impaired in the past. There might have been a reversal of some of the previous impairment loss. The reversal of the impairment loss should be recognized immediately as income in profit or loss. The carrying amount of the asset should be increased to its new recoverable amount. An exception to this rule is for goodwill. An impairment loss for goodwill should not be reversed in a subsequent period. But for the rest of the asset, you can reverse the impairment loss if there is an improvement in the recoverable amount subsequently. So this was also a rule which we learned earlier, but we can use this example to practice this reversal of impairment loss. Example is a cash generating unit. Again, be ready. I want you people to solve this small example. But anyway, I'll be reading it for you, so be careful. A cash generating unit comprising a factory, plant and equipment, etc., and associated purchased goodwill becomes impaired because the product it makes is overtaken by a technologically more advanced model produced by a competitor. The recoverable amount of the cash generating unit falls to 60 million, resulting in an impairment loss of the 80 million allocated as follows. Carrying amount before impairment, carrying amount after impairment. 40 million goodwill all gone, patent all gone with no market value, it all gone, destroyed, this means, and tangible non-current assets, the remaining amount is allocated to these assets, and now these assets have carrying amount after impairment 60 million USD. See, now what happened? After 3 years, the entity makes a technological breakthrough of its own, and the recoverable amount of the cash generating unit increases to 90 million after 3 years. The carrying amount of the tangible non-current asset, had the impairment not occurred, would have been 70 million. Calculate the reversal of the impairment loss. Calculate the impairment of the reversal of the impairment loss. So you can calculate it, then I can give you various options. I can give you 2 options, but don't pop up the question right now. Let them think by looking at the example, by looking at the information given in this example.
So they are required to calculate the reversal of the impairment.
Simple, yes, very simple. Okay. So I can give you people, but we are giving you 2 minutes to calculate, but 2 minutes are more, but anyway, take 2 minutes to calculate the amount to be reversed. Okay, now you can pop up a question.
Give me the options.
Write first the statement. Calculate the reversal of impairment loss.
I have written.
Okay. Option one. Option one is 10 million.
10 million.
Option two is 30 million.
13.
30. 30 million. These are the 2 options.
Only 2 options.
Yes, only 2 options.
Okay. So guys, wake up. Here is your another poll question. I hope this time you will chase the last figure of participation that we have achieved in last poll question. The response rate goes straight to 14%. That is very good. You have 30 seconds. Please, I request you all to participate. So for 16%, I hope this question is reaching at your Windows desktop screens or laptop screens. So we have achieved 20%. Few seconds left only. Okay. I think I should close now.
Yes.
Okay, I'm going to close it now. 69% people saying 10 million. while 30% people are saying, 31% rather, 30 million.
69% are saying 10 million.
10 million.
69% are correct. See, what is the principle in fact? Actually, the answer is already given within the example. The principle is the reversal of impairment is recognized to the extent it increases the carrying amount of the tangible non-current asset to what it would have been had the impairment not taken place. That is, reversal of impairment loss of 10 million is recognized and the tangible non-current asset written back to 70 million. You cannot go beyond the 70 million, like this amount. What is this 70 million in fact? This 70 million is carrying amount of the tangible non-current asset. Had the impairment not occurred, would have been 70 million. Simply calculate the carrying amount of that asset, ignoring the impairment at the point of reversal, till the point of reversal. So while reversing the value of that asset, you cannot go beyond that amount. This is the simple principle for 31%. If 31% have any question, we can answer now related to this if they need some more explanation. But the explanation is quite obvious. So now we can have a Maghrib prayer break and then we will continue.
I must request to all the attendees to stay connected while in the break session, because we have some sort of other things to be done, like we have to offer prayer in the meantime. So I request you all to understand and please stay connected with us, because I have seen lots of people leaving during the break. So there is a misconception, I think. They thought that we ended the session, however, we took breaks. So I think you will be available with us. And thanks to all those who wait for us to come back again and start the session from where we have left. Thank you, everyone.
Okay, uh, so we were discussing reversal of increment of
We have
impairment.
one member over here who is asking that kindly provide order of reversal for impairment loss as well. Order of reversal.
uh, Order of reversal of impairment loss. Of course, you will not be like reversing goodwill. Something damaged, that will not be reversed, of course, because that is damaged. So this will all be allocated to the like assets, these assets. Uh, this will all be allocated to these assets on a pro rata basis. But the principle will be like you cannot like increase their amount uh, beyond the figure which would have been had there been no impairment. Okay. Do you have any question? Okay. There is a question from Babar Khatak. He has sent me a small, you can say that a case study, which I found I should share with you people, because similar situation can arise for you people as well. Is Babar Khatak there? If he's there, please tell us. Okay. Small scenario is you are a CFO in a hospital, and
He's not here right now.
okay, he can see the recording of this session.
Yes.
Recording of this session, because I found this small case study interesting and could be beneficial for our other members as well. You are a CFO in a hospital, and the hospital has recently purchased a unique bespoke medical equipment. the equipment is the first of its kind uh, and installed uh, in your hospital. The supplier has charged you nothing but has conditioned you to purchase medical consumables to be used by the said equipment only from him for next 3 years. The quantity of the said consumables to be purchased over the 3 years period of time is not predetermined. It could be zero or in millions, and the supplier does not mind that. How would you determine the cost of the equipment in question? This question is in fact related to the determination of the cost of an asset, a fixed asset, for initial measurement purpose. And there is no active market, therefore, that could have enabled you to gauge a reasonable fair value of the asset for the purpose of its initial recognition in hospital books. In this scenario, actually, some more information should be there. Like the approach in such case, like you bought an asset, they have given you this asset, and they said you will not be paying anything for this asset, but for 3 years, all the supplies required for this asset will be bought from the supplier of this asset. In fact, the price which you will be paying for those supplies is not only for the supplies. Those amounts has got two components. One, the one amount relates to this asset and the other amount relates to the supplies. Now the question arises, like there is no, fair value is not available. This asset is not being actively traded in the market. The other method is, like if fair value is not available, what you can do that, you can find out, like if you just buy supply from another supplier who has not supplied you the machine, what will be the cost of those supplies? This means whatever is the cost of those supplies, the remaining amount which you are paying on account of these supplies will be the cost of this equipment. There are other methods. If we can have details of the contracts related to this free supply of the equipment, then we can recommend even more method for the determination of the cost of this equipment. There is no concept of free. Anyway, if at the end of the day you find that literally it is free, if you just buy the supply and you will have to pay the same amount, and he is in addition to those supply is providing you the equipment as well, in that case this is something, if you get some sort of grant, so you can recognize it as a deferred income, and you can spread it over. This is not government grant, but this is my professional opinion. If in case, which is very rare in this world, because of donation, they have given you people a donation, so there you have received this asset as a free, there you can go for other treatments as well. So this was the question of Mr. Babar Khattak. Okay. Now, I am leaving international accounting standard for you people, and you know that international accounting standard 38 relates to the intangible assets. There is no, I would say there is no, in fact, change. If there is any that is negligible change, this is the same. I'll be sending you the slides, which will provide you all the details, all the basic detail related to intangible assets. And after going through those slides, if you have any question, you can ask that question, because there is no change in this standard. During this 3-day session, we have covered, we tried to cover accounting for fixed asset, and we were able to talk about International Accounting Standard 23, International Accounting Standard 40, then International Accounting Standard 20, then International Accounting Standard 16, and Interpretation 1 related to the accounting for changes in the decommissioning and restoration liability. And at the end, we discussed International Accounting Standard 36 very briefly, and we refreshed the main concept from this standard. So this was all about our session. And if you have any feedback, if you want to provide us any feedback to improve these sessions further, so you are welcome. Similarly, if you have any question which you wanted to ask, you can send it through email, which is already available with you people. Or if you have asked any question that was not answered, even that question can be sent through email. And even as I said earlier, if you have like any other query related to these standards, those aspects of the standards which were not covered during this 3-day session, so please feel free to write me. I'll be happy to answer you people. But while writing, please try to give as much as information possible, and be specific, and be clear in your questions, and so that we could get a better understanding of your question, and this will help us in answering it in an appropriate way. So I would request Mr. Khayyam to pop up feedback question about your feedback related to the to this session. So okay, just 1 minute, please. Don't because we already spent it 3 hours. So just give us 1 minute, and your feedback is very important for us.
This poll related to our session. You guys have to give us your feedback. Here it is. Please, guys, participate more in this poll, as we are interested to know that if you will be gaining some value from these sessions. I hope you guys have received value out of it. Rather, I must say intended value out of it, because we have worked so hard on it. So far, 26% people have voted. I must appreciate you guys who have participated in this poll. But I think at least 50 to 60% people should participate in this poll. So far, 30% people have voted. I think. Please, guys, you should participate in this poll. Okay. I'm going to close this poll now. Okay. Here the figures. 34% people saying excellent. 51% people saying very useful, and 13% people saying good.
Thank you very much for your feedback, and this is the end of the session, and thank you very much for your participation and for your feedback.
Thank you, everyone. Have a nice weekend from my side as well.
And from my side as well.
Take care. Love. Goodbye.